Have you ever just stared at a stock chart and thought, what am I even looking at? It just looks like a bunch of random, chaotic noise, right? It can feel super overwhelming. But what if I told you it's not random at all? What if it's really a story, a play in 4 acts that follows a surprisingly predictable script driven by human psychology? Okay, let's dive right into this.
I mean, look at it. To the untrained eye, all those daily ups and downs, the crazy spikes and sudden drops, it looks totally unpredictable. It's so easy to get lost in all that and just assume that any success in the market is pure luck. But that's really not the whole picture.
See, underneath all that surface-level chaos, there's a pattern that repeats itself over and over and over again. It happens in every market, on every time frame, and this whole cycle, it's fueled by the collective emotions of everyone involved. Once you learn how to read this script, the market stops being this big, scary mystery and starts becoming a story that you can actually follow.
Now, every good story has its main characters, right? Well, in our market story, we've got 2 big ones. First, there's the smart money. Think of the big institutions, hedge funds, the major players with deep pockets. And then there's the public. That's us, the retail investors, the crowd. The entire market cycle is basically just a story of how these 2 groups interact, and here's the kicker. They almost always act in completely opposite ways at the most critical moments.
All right, let's get into Act 1 of our play. This is the beginning, it's the quiet part of the story. It's called accumulation. This is where the foundation for the next huge move is being built, way before most people even have a clue that something is happening.
So, what does this stage actually look like on a chart? Well, you're going to see a long, kind of boring, sideways price movement. It really feels like absolutely nothing is going on. The volume starts out super low, but then you'll see it subtly start to creep up. The price will keep testing a lower boundary, a support level, but it just refuses to break down for good. And the grand finale of this whole act, it's often this really clever trap called a spring.
Now this is where the psychology gets really fascinating. While the price is just drifting sideways, the smart money is incredibly busy. They are quietly buying up or accumulating shares from anyone who's willing to sell. They're actually trying to keep the price down so they can get the best possible entry. And who's selling to them? The public. At this point, the news is usually bad, everyone feels pessimistic, and people are just bored or scared, so they dump their positions thinking the asset is totally dead.
Okay, let's zoom in on that spring. This move is a total masterstroke by the smart money. What they do is, they push the price just for a moment below that key support level. This move is designed to do one thing. It triggers a wave of stop losses and it panics the last few nervous holders into selling their shares. And once all those sellers are flushed out of the market, the price snaps right back up. It's like the final cleanout before the real show is about to begin. And that brings us to Act 2, the markup. The quiet setup is totally over, and now the story gets really exciting. This is the uptrend, the phase everyone dreams about catching. This is where prices begin that strong, sustained move to the upside.
The first clear signal that we're in Act 2 is a big, decisive breakout above that long sideways range from Act 1. But here's a little trick to watch out for. The very first pullback after that breakout is often super deep and scary. It's designed to shake out anyone who just jumped on the bandwagon. But after that, a healthy uptrend will just keep bouncing off key moving averages. You can think of those as trend-following lines. And other indicators like the RSI will stay in a really healthy bullish range. So what's happening behind the scenes? Well, this is where the psychological shift is just massive. The smart money, the ones who bought way back at Act 1, are now just sitting comfortably on their positions, maybe taking a little profit off the table here and there. But the public? Their entire sentiment flips. That boredom from Act 1 turns into intense FOMO, the fear of missing out. The news is getting better, they see the price ripping higher, and they start chasing it, buying in at much, much higher prices. But, all good things have to come to an end, and Act 2 can wrap up in one of 2 main ways. The first is what we call a climax run. It's this spectacular finale where the price just goes vertical, totally parabolic, shooting straight up. The other ending is a bit less dramatic. It's a channel break, where the price just kind of falls out of its uptrend on a big spike in selling volume. Either way, these are both huge signs that the music is about to stop. And that leads us right into Act 3, distribution. Now this one is by far the most difficult and deceptive part of the story to read. On the surface, it often looks just like that boring sideways action from Act 1. But its location and what it means are completely different. This is the top.
So on the chart, you'll see a sideways range again, but this time it's happening after a huge run-up. The volume is high, but it's choppy, there's no clear direction. That's a sign of a massive battle between the last of the buyers and the first of the sellers. You have to watch out for upthrusts, which are these false breakouts to new highs that are just designed to trap hopeful, greedy buyers. And as this stage goes on, you'll start to see these sharp, sudden drops, capitulation days, as the foundation of the trend really starts to crack.
Now get ready for the ultimate reversal of roles. This is the climax of the whole psychological drama. The smart money, they're the sellers now. They are quietly and methodically selling off or distributing all those shares they bought way down low. And who are they selling to? You guessed it, the public. The news is absolutely fantastic. Everyone's bragging about how much money they're making. Euphoria is at an all-time high. The public is totally convinced the price is going to the moon, so they're buying with both hands, taking every last share off the hands of the institutions who are quietly heading for the exits. So, once that last share has been sold by the smart money, the support that was holding the price up is just gone. And this kicks off the tragic final act of our play, Act 4, the markdown. This is the downtrend. This is where all that euphoria from Act 3 turns into fear and eventually into pure panic.
The markdown begins with a very clear break below the support of that Stage 3 distribution range. You'll see really high volume on the down moves, which confirms there's heavy selling pressure. All those moving averages that were acting as a floor on the way up will now flip and act as a ceiling on the way down. This really painful phase only ends when the selling pressure is finally exhausted, and you see that when volume just completely dries up at the lows.
And this is the emotional roller coaster for the public investor. The smart money is gone. They're on the sidelines, sitting in cash, just waiting for the whole cycle to begin again. But the public, who bought at the very top, first they go into a state of denial. They tell themselves, oh, it's just a pullback, it'll come back. But as prices keep falling, denial turns to fear, then anxiety, and finally, just outright panic. They capitulate. They sell everything right at the bottom, usually for a massive loss, right as Act 1, accumulation, is quietly about to begin all over again. Okay, so now that we know the 4 acts of the story, how do we actually get better at reading the script as it unfolds? A really fundamental tool for this is understanding the concept of support and resistance. You can think of them as the key plot points in our market story.
Now, listen up, because this is probably the single most important takeaway from this entire explainer. Support and resistance are not exact single price lines. You have to think of them as zones or areas. And why is that? It's because they represent a huge concentration of orders, people's stop losses, their buy orders, their profit targets. It's an area where a big battle between buyers and sellers is very likely to happen.
Let's break down the human emotion that actually creates these zones. A support zone forms because you have new buyers who see value at that price, and you have sellers who sold earlier and now regret it, so they want to buy back in. A resistance zone is created by all the people who got trapped buying at a previous high. Now they're just desperately trying to sell and get their money back at break even. And a breakout? That's a pure psychological chain reaction. It triggers all the stop losses from people betting against the move, and that buying pressure fuels the FOMO of everyone who is sitting on the sidelines. See? It's all psychology. So there you have it. The market cycle isn't just random noise. It's a 4-act play. It's the story of the transfer of assets from the patient smart money to the emotional public, and then right back again. And the thing is, this script just repeats itself. So the final question I have for you is this. When you look at the markets right now, which act do you think we're in? Which part of the story is being told today?